Greetings and welcome to Bloomberg New Economy Conversations. I'm Andy Browne. Can the finance industry save the world from climate catastrophe? To avoid the worst outcomes, we need a new industrial revolution, a green one. And that's going to require a massive reallocation of capital to those companies working on innovations in power generation and distribution, transport industry, and manufacturing. Banks have a critical role to play. So do institutional investors who control trillions of dollars of savings. But how can these players mobilize capital in a way that maximizes impact, recognizing that we are running out of time? Most importantly, how can we avoid greenwashing, where we fool ourselves into believing that we're fixing the problem when all we're doing is extending business as usual financing arrangements or even making things worse? Here to discuss these issues with me is Noel Quinn. Noel Quinn is the Group Chief Executive for HSBC. He also chairs the Sustainable Markets Initiative's Financial Services Task Force, which works to accelerate efforts within the banking sector to move toward a net zero economy. Tariq Fancy previously served as the Chief Investment Officer for Sustainable Investing at BlackRock in 2018 and 2019, where he was responsible for the integration of environmental, social, and governance, ESG, considerations across the investment activities of the world's largest asset manager. He currently serves as CEO of Rumie, an education technology nonprofit that he founded in 2013. Anne Simpson is the Managing Investment Director for Board Governance and Sustainability at CalPERS, the California Public Employees Retirement System, responsible for strategic initiatives across the total fund, where she is a member of the Investment Management Committee and reports to the CEO. She currently chairs the Steering Committee and Asia Advisory Group for Climate Action 100 Plus, a global investor alliance of, believe it or not, $55 trillion, which CalPERS convened and co-founded. Coming up a little bit later in the program, we have an interview with Jae-Hyuk Oh, Vice President of New Energy Business Development at Hyundai Motor Company, who has been incubating new energy businesses, mostly in the area of hydrogen, the reuse and recycling of EV batteries, and energy as a service since 2017. I'm joining you today from Bloomberg headquarters in New York, and I'd like to welcome our global new economy community. We also welcome our viewers tuning in on social media and via the Bloomberg terminal. There will be opportunities throughout this conversation for real-time input from you, our audience. I encourage you to submit questions in the text box in the bottom right of your screen, and I'll invite you to vote in live polling in the top right of your screen. If at any point you encounter technical difficulties, a simple refresh of your browser should help get things back on track. I caught up last week with Noel Quinn, who in his role as chair of the Financial Services Task Force is focusing on developing pathways to meet a number of climate goals, such as net zero, carbon emissions targets, climate solutions, and accelerating investment into sustainable infrastructure in the lead up to the UN Climate Change Conference, COP26, in Glasgow this November. I asked Noel what we can expect from the financial sector on climate and what he expects from the upcoming summit in Glasgow. What are your expectations for COP26? A UN report last week said government pledges on carbon are way off target, and we're on track for 2.7 degrees of warming versus, of course, the Paris goal of 1.5 degrees.
Andrew, I can only speak as I find at the moment in the dialogue I'm having with clients. The pace of change that's taking place in the customers I'm talking to, in all markets we operate in, is just accelerating. I think COVID has really given a wake-up call to everyone on how important this topic is and how fragile the world economy is to a natural event. So I think there's a huge amount still to do. It would be great if we had started earlier as a world, but there is an awful lot of activity taking place. The governments have their role to play, but we as institutions and private institutions have our role to play. And I do see COP26 really about bringing the private sector onto an agenda that was really a public sector agenda at the previous COP. And it's a combined effort.
How do you assess the risk to your own portfolio from climate change? For instance, the risk that fossil fuel companies are going to be displaced by clean energy, the risk that whole swaths of coastal real estate could disappear underwater. Do you run stress tests for various climate scenarios?
Yeah, we do. And I'd look at it. I'm not denying there are risks around climate change, and there are risks to certain business sectors that exist today and business models. But I turn it around and look at the opportunity. And that is the opportunity to help clients change their business model. I said to my own colleagues, I think we're about to witness the next major change in the industrial and commercial landscape of the world in the next 10 years and 15 years. I liken this to some of the changes that we've seen over the past 156 years of our history. It's one of the biggest revolutions in the industrial landscape that I think we've seen. Now, that brings opportunity and it brings risk. The opportunity is to finance that transition, to finance the investment in the new technologies and the new business models. And that's what excites me, whilst being cognizant of the risks. If you don't get on that journey and you're left with all of the stranded assets of the old technologies, clearly you have a risk.
So how does that understanding or vision of the world experiencing a new industrial revolution affect your lending decisions today? Are you more inclined to lend to businesses that are planning for a low carbon future, less inclined to lend to companies with large climate footprints?
I don't think the answer is binary, because I was on a conversation earlier and I said, look, there are certain companies that are very specific on green energy or a project-based company. But the vast majority of companies in the world serve all sectors and are both in today's industry and future technologies. And the real trick is to help those companies that have a mixed portfolio of activities transition their business model to the future. If we only do financing of pure green projects and we don't help the existing industries invest in their business models to change the technology they have, then we're going to have a very binary world. And I don't think the world is as binary as sometimes people talk about.
You're not in favor of divestment. Why?
No, I do think there is certain parts of the industrial landscape that are going to get progressively less finance provided to them. But I don't think that is purely a function of the finance sector regulating our companies that we bank. I think the companies we bank are already thinking in that direction. In conjunction with the government policies that are being formulated, the oil and gas sector that I talk to are very much interested in investing in the new technologies and lessening their dependency on current technologies and current energy sources.
As a response to shareholder pressure, HSBC has just agreed to phase out funding for the coal industry by 2030 in the developed world and by 2040 in the developing world. Is that not a form of divestment?
That's a form of economic reality. I think everyone knows that you've got to be led by the science. The science, and I'm not a scientist, but the science is telling me that the world of the future cannot be dependent on coal as a source of energy and be consistent with net zero by 2050. That's an economic reality with that ambition of net zero by 2050. Therefore, it's going to happen over time. And that's what we're saying. Our clients are going to transition their business models off of coal onto new sources of energy. And that will be why we will transition our balance sheet, because they are transitioning their businesses.
But you've set a hard target. You've set a goal.
Because the science says you have to do that. If you don't get out of the developed world by 2030 and the developing world by 2040, it's likely we will miss the scientific base and the scientific scenario that gets us to net zero by 2050. So I can't turn around and pick a different date just because I like it if the science is telling us that's what needs to be done.
What's the science telling us about oil? Why wouldn't you make a similar commitment, for instance?
There are similar statements being put out there by IEA, and we're going to be working with our clients on the implementation of the IEA principles and how that will impact. But again, it's not about necessarily just pulling out. It's a case of how are those oil and gas companies going to change their business models in light of the IEA scenario?
How do you go about monitoring your clients' emissions, the so-called Scope 3 emissions, and how does that play into your decisions on whether you loan to them, and if you do loan, at what price?
Yeah, that's a great question, Andrew. And the whole world, the corporate world, has to actually start to gather information that we've not previously gathered. That's the banks and our clients have got to build a much more transparent analysis of the current carbon footprint, of their plans to transition for the future. We as institutions will have an obligation to gather that information from our clients so that we can make appropriate lending decisions and decisions as to whether we can achieve our net zero ambition as a company. But I think as an activity, there's a huge amount of thinking going into how to build that transparency, and there are methodologies being discussed, PACTA and PCAF, and science-based scenarios being used. I'm chairing a task force on that, a group of 11 of us as banks are trying to make sure that we develop a framework as a group of banks that can bring meaning to the phrase net zero by 2050. So there isn't just a strap line, it isn't a marketing statement, it has substance. And if you use that commitment, if you use that statement in your commitment, then this is what you need to put in place as a reporting architecture for your investors and stakeholders. We're intending to publish that document, which is the Financial Services Task Force, under the SMI banner.
No, in the end, can we trust businesses to address the climate crisis? There are those who argue that businesses have a fiduciary duty to maximize profit, which may or may not align with the best interests of the planet. And ultimately, it's up to government to mandate change by, for instance, introducing a carbon tax. How do you respond to that kind of argument?
You're implying that there's a disconnect between climate change and profit. I'm arguing there is a strong connection between climate change and profit, and that if you lean into the opportunities that exist in financing the transition to net zero, there is a significant profit opportunity for you. If you do not proactively lean into that challenge, there is a potential risk that you'll end up banking stranded assets because they're no longer viable in a net zero world. So I don't see the disconnect between profit and climate. I see them strongly connected. Is there a role for government? Absolutely. Government have a strong role to play. Carbon pricing is one role they could play. It's wickedly difficult. Coming up with a single global price for carbon, universally accepted by all governments of the world, able to operate cross-border, is great, but it's challenging. There are other things governments can do. They can send strong market signals and have done so. The signals the UK government have made regarding the use of the combustion engine is a market signal beneath carbon pricing that can change market dynamics. Similar statements could be made around sustainable aviation fuel for the long-haul aviation sector, using that as a means to lower the carbon footprint of the airline sector. There are many such statements that could operate below the level of a global carbon price in the absence of such a global carbon price.
Does ESG investment make a difference? Critics will say that it simply amounts to a reshuffling of the portfolios.
Yeah, listen, I've been around long enough, 34 years in this organization, and seen lots of different innovation and change take place. I'm an optimist. But now that the world is really energized behind the need for change, that new technologies will be invented, new opportunities will be created. Those projects need to be funded. The banking sector and the financial services sector has a strong role to play in that, as do governments. And if we're going to get that 2050 vision that we all want, we have to fund those very technologies and projects. But to do so, you need a strong label. You need people to be able to say, as investors, I see that project. I recognize it has the credentials of sustainability around it, within it. I see that it has validity. If you have a strong definition of a sustainable project, finance will follow. If you don't have a strong definition of what is sustainable, it's hard for investors, be they equity investors or debt investors, to put their money behind that. So definition of sustainable investment is important. Now, there is a complication, Andrew, and that is, if you're just looking at it at a project level, you can get to a definition of a sustainable project, whether it's the EU taxonomy or others, or fast infra is in development.
What worries you the most as we've been watching a procession of record-breaking heat waves, droughts, hurricanes, and so on? Will we be able, do you think, to make the shift to a low-carbon economy fast enough?
I believe so. I hope so, and we're making every effort to make sure that's what happens within HSBC. You know, I'm open enough and honest enough to say I need to build greater capabilities within HSBC to be ready for those new businesses that are going to be created and those new technologies, because I want to fund them. I want to help our clients make them become a reality. Now, do I personally, I'm not a scientist, do I understand all that science? No. Do my people understand it all? No. So we're building the capabilities within our organization to make sure that our frontline bankers are able to have this dialogue with their clients. And I think what the industry has done over the past 10 years is been very successful in, for example, the bond market, the capital market aspects. But we as an institution have got to embed that capability of financing sustainable projects throughout our activities: asset management, wealth management, SME banking, supply chain finance and trade finance in Asia, in the Middle East, and around the world. Our bankers in all parts of HSBC have got to be able to make good, solid risk and opportunity assessment decisions going forward across the broad portfolio of our activity. So I'm in a very heavy build out of capability to make sure we're able to meet that requirement.
Noel Quinn, thanks for your time, and thank you for your insights, and good luck at COP26.
Thank you, Andrew.
And now let's move to our live panel. Just a reminder to the audience, please do send in questions, and if you send them in, I will certainly read them out. I want to start with Tariq. You made waves a few weeks ago by writing a 3-part essay in medium.com where you brutally critique all of the work you did at BlackRock, where you were in charge of ESG investing. You've gone from ESG believer to apostate. You write, and I quote, "I sincerely believe that while sustainable investing was not perfect, it was a step in the right direction in the critical question of how business and society should intersect in the 21st century." But you then go on to say, quote, "It's clear to me now that my work at BlackRock only made matters worse by leading the world into a dangerous mirage, an oasis in the middle of the desert that is burning valuable time. We will eventually come to regret this illusion." Tariq, what did you see at BlackRock that prompted this dramatic about-face?
I would say that I saw a set of tools, standards, and data sets, pieces around the space that were growing and had potential if combined in a useful way for society, but they weren't being. They were being combined into narratives that try to convince people that free markets self-correct without any kind of regulation, and that we can solve massive challenges like inequality and climate change simply through the leadership of banks and financial institutions that have a fiduciary duty to maximize profits in a world where I think it's very clear from everything I saw that being irresponsible is actually profitable, right? This is one of our underlying problems. And so most of what we were doing wasn't really creating any systemic change as much as lulling a sort of fantasy that was delaying the action by government required to create that. And then as sort of one hand, sort of the industry was holding off taxes and regulation and maintaining a consensus that we could argue emerged in the 80s around the idea that free markets, all by themselves can solve all problems. We saw, with the other hand, this creation of a set of products. And those products all purported to create social impact in some meaningful way. And I would argue were sort of, in some ways, created to exploit the social angst of society around the fact that nothing was getting done. And every year inequality goes up and carbon emissions exceed the levels we need them to be at to hit any reasonable scenario. And those products, for the most part, have no impact whatsoever. There's no reason to believe that they do with any basic understanding of finance. There's no reason to believe they provide, for the most part, additional capital to companies or causes like this. And so I became very worried that, for the most part, the industry was creating what I call something that looks like giving wheatgrass to a cancer patient, right? There's a slow-spreading cancer. It's a systemic crisis, much like COVID-19, but whereas the incubation period for COVID is weeks, in this case, it's decades. And that enabled the fantasy where we basically were saying, well, we can keep the status quo the same way. And Wall Street was selling a bunch of products that, for the most part, were just shifting money around and handing it to socially conscious investors at higher fees. With no evidence that it creates any social impact whatsoever, and now evidence emerging that the messages around that actively mislead the public into believing that we don't need government reform, we don't need regulatory reform, which, of course, is what all of our societal experts and economists and Nobel Prize winners are telling us. It created a delay.
So just to follow up, your argument, if I'm reading you correctly, hinges on the idea that the only real answer to climate change is to put a price on carbon. Absent that incentive, companies will continue to focus on short-term profits at the expense of the long-term health of the planet. But that seems to me a bit impractical. I mean, you just heard Noel Quinn say that it was going to be a carbon tax is wickedly difficult. The US is not going to put a tax on carbon. Many developing economies, the fastest growing source of emissions in the world, won't do that either.
Listen, there's no question that implementing a carbon tax is going to be politically difficult. But it's also what our experts are telling us we need to do. I would turn around to business leaders that say that it's very difficult to do anything because public opinion is against it, and say, well, what are you doing to help that? I don't think it makes sense for business leaders to, on one hand, be saying, using their marketing divisions to create the impression that we don't need regulation, using lobbying efforts to slow that down, belonging to industry organizations that are reflexively anti-taxes and regulation. And frankly, by going out there and saying that, listen, this is a wonderful investment opportunity and we want to make money from it, when clearly the economic consensus is that this is going to cost us $50 trillion to decarbonize the world economy. You can't have it both ways, right? And sort of say, well, this government's not doing anything, but you're also weaving a thesis that's misleading the public into believing that we don't need government to do anything.
Before we get to Anne, I'm starting to feel a little sympathy for your former boss at BlackRock, Larry Fink. I mean, he can't do anything about putting in place a carbon tax. He doesn't run the government. He does, however, run a massive pool of capital that could nudge companies in the right direction. In other words, he's doing what he can. What's wrong with that?
I think that the issue is around the messaging, right? I would agree. I don't think that Larry Fink can solve all of our problems, but isn't. I think that he can't, and is implying that he can. It's one thing for him to go out there and say, listen, finance is going to follow the money. We're structured to do that. He doesn't even control what the portfolio managers do. They have a fiduciary obligation to improve returns and financial incentives to do it. It would be one thing if those leaders went and said, listen, we can't solve these problems and we need government to come and create the incentives and structure to do that. Kind of like, athletes in a game saying at some point this game is getting dirty and it's in no one's interest and we need referees. But that's not what's being said. what's being said is that this is an enormous investment opportunity, that social purpose is the answer to societal angst. And we have to ask ourselves, I mean, I'm a fan of Larry. I think he's brilliant. But at the same time, he holds a bunch of positions that I think are not coherent. One of them is believing that capitalism is too short term, and the other is saying that capitalism can solve long-term social issues at the same time.
Okay, let's bring in Anne. And listening to Tariq, I'm reminded of that quote: "Everything must change for everything to remain the same." Is that what's happening in ESG? Is it really business as usual in an environmental packaging?
No. I mean, the first thing where I completely agree with Tariq is this question of the ESG gold rush, all the new money flooding into funds, the marketing opportunity. But this isn't something specific to ESG. Snake oil is as old as the hills. And if you look back on the early court cases complaining about snake oil, the complaint was there's no snakes in the snake oil. The later court cases were, well, why are we taking snake oil for everything from impotence to hair loss to, preventing aging, or whatever these miraculous claims were. So I think this puts a premium on an area of reform which is long overdue, which is thinking about investor governance. So there's a big agenda, rightly so, around corporate governance, corporate reporting. I think the other thing Tariq is rightly pointing to is the role of government. But asset owners like CalPERS fully understand it's not only, but also. We need the financial markets, need two things from regulators. One is the markets rely upon a flow of information. And right now, we simply do not have the standards and metrics for integrating this sustainability information into the corporate reporting that investors rely upon. So all praise to the IFRS, to the work at the EU, and also work underway at the SEC. So the regulatory side, in part, is responding to investors who are going there and saying, look, we can't do our part in the financial markets unless you do your part, which is to get the disclosure rules in place. That's one piece. The second piece is incentives. Likewise, you look at initiatives like the investor agenda, which was formed before the Paris Agreement. So the presence of finance, civil society, and business, genuinely, I was there in those meetings in Paris. That was the first time there had been a COP at which you had this very broad range of input. It wasn't just government ministers stuck in a basement drinking coffee from styrofoam cups. It was an understanding that this partnership between public, private, and civil society is what's needed to get us over the line. So even if we're looking at the role of investment managers, we have to appreciate they're investing other people's money. Larry Fink is not investing $7 trillion that he inherited from his auntie Mabel. This money is the savings that have been accumulated from, millions of hardworking people and put into the financial system, which is why ultimately we have a common interest in the long term, making sure we have this sustainability integrated into the financial markets. Now, I would say the other issue is what can be done by the financial markets without those policy reforms. And I'm a little more optimistic about, things being wickedly difficult is not unusual. If something is as complex and challenging as pricing an externality like the impact of global warming via carbon emissions, don't expect that to be simple, particularly when we don't have a world autocratic government that can just simply write the rules. But certainly this has been on the agenda for investors from before the Paris Agreement. Likewise, the call for mandatory risk reporting has been on the agenda. Now at COP26, we finally got to the point where I think there's some consensus on the regulatory front, both for International Accounting Standards Board and the IFRS that governs it, establishing a new standard setting body, and for the SEC agreeing to write these rules. The other thing I do want to say is the asset owners like CalPERS, and I just for clarity, Most of our money is internally managed. About 80% of the portfolio is internally managed, and we're not clients of BlackRock. However, BlackRock was right there with us, voting to put new directors onto the board of Exxon. Why did that matter? Because Exxon was one of the companies refusing to budge on some quite big strategic issues. And we're at the point where we say, well, the answer here is not to divest and pass your shares off to someone else. The issue here is actually to hold the board of directors accountable. So the fund management industry needs to be serving the needs of their clients, who are the asset owners in one form or another, and making sure we have that accountability and reporting built into the system is very important.
And you bring an awesome amount of financial firepower to this battle. $400 billion through CalPERS, $55 trillion through the Climate Action 100+ initiative. You gave an example of changing the board or shuffling the board at Exxon. What other examples can you provide?
3 new directors.
Three new directors at Exxon. Can you give us some other examples of how you have exercised your financial leverage to change corporate behavior?
Yeah, let me give you 2 examples. The first thing is to frame all of this work as risk and return. That anchors it onto the fiduciary duty that we have to our 2 million members. You know, the firefighters, the judges, the janitors, the public servants in California relying on us, not just for pensions, but for healthcare as well. So a pension fund has a social purpose. However, that social purpose is going to be fulfilled if we're successful on the financial returns. So for every dollar we pay in pensions, over 50 cents comes from investments. So one reason me particularly, not a fan of ESG as the way to describe this, is there's no F for finance. So the way we frame this at CalPERS, and we did this some years ago, is to redefine what we mean by investment. So we say there are 3 forms of capital that need to be effectively managed to produce long-term sustainable value. There's financial capital, yes, the traditional day job of an investor to manage that. But also we're saying human capital, natural capital are the 3 that need to be holistically managed. So even if we're looking at an issue like climate change, we also need to be thinking about the impact on the workforce, on communities, on supply lines, and so forth. And that holistic approach, thinking about financial, human, and natural capital being managed together is, I think, ultimately a more practical way of thinking about this issue than ESG over here is an acronym, and then you've got to find some way to integrate it. And if you're a fund manager, you're an intermediary, so then you've got to sell things to earn fees. You know, if you start at the top of the investment chain with the asset owners and look at the way that not just CalPERS, but others are thinking about it, you'll see that we're approaching it as a fiduciary issue, as part of our fiduciary duty to our beneficiaries. Now, what difference does it make? Well, I think investors have, as I said, had a very visible impact on the corporate reporting agenda. Just for CalPERS, we've sat on the advisory committee at the SEC, also for CII. My colleague James Andrews sits on the IFRS Advisory Council. We are actively present and involved with the regulatory agencies. We give testimony to Congress, we write comment letters and all of that. So that's one area of work, that's advocacy. The engagement piece, obviously, Exxon was this season's high watermark in terms of board accountability and showing what investors can do. But I'd like to quote something from Bloomberg New Energy Finance, as we're on a Bloomberg meeting. It was wonderful yesterday to see the report where Bloomberg has calculated what's the value in terms of reducing emissions of the Climate Action 100+ results. So I think you all know where this came from. We looked at 10,000 companies in our CalPERS public equity portfolio. We found that 100, less than 100 actually, were responsible for over 80% of the emissions. So this question of can it be done, is it wickedly simple or just, simple in the normal way of being very complicated? What we did was say we need to have 3 things for these 100 companies. Governance, so Exxon example, hold boards accountable, but also align compensation towards the net zero goals, political donations, because we need to untangle shareholder money from the policy and rule writing process, and also that we want strategies put forward for a just transition. And for this, we've built out a benchmark which tracks everything from CapEx to those political donations, time-bound emissions reduction targets, and so forth. So to answer your question, we can go through individual company examples, but as a cohort in the 100 plus, Bloomberg has a new energy finance assessed that the 111 companies which we have engaged rigorously and vigorously that have set net zero targets. Remember, these are very tough companies in hard to abate sectors, steel, cement, utilities, aviation, agriculture, and as well as the production side. Those 111 companies, the emissions value of that net zero commitment is equivalent to China's annual emissions. So we're talking about very significant impact that investors can drive. That will take us part of the way. But then investors also know they need public policy to come in alongside this to accelerate the pace and scale of what's going to be needed. On the plus side, that's risk. Let me just add one very, very quick other point. And I think this was well said in your clip at the beginning about with HSBC. Because we have to deploy capital to earn returns, to pay pensions and healthcare, we're also very interested not just in the doom and gloom, but also in the opportunity. And when we did our own first TCFD report published last year, we assessed that about 20% of our private markets assets are now invested in climate solutions. So we need to both be the stewards to drive down the emissions and create the demand for the clean energy across all of these sectors. But we also have a huge opportunity by deploying new capital into the opportunities that are there as well. So we need to be doing both.
Thank you.
Thanks.
That's a great point. I'm glad you brought up Bloomberg New Energy Finance, which always comes up with the
great
very
fans.
best data.
Yes.
And Tariq, before we get your response to what Anne has just said, I'd like to go to our first audience poll, and the question is. The question is, does ESG investing make a difference in the race to net zero? Now, we've given you 4 options here. Yes, it's becoming an unstoppable force that obliges managers to consider the planet before profits. B, not yet, but it will once we have better standards in place for reporting. C, it's a great concept, but it can't make enough of an impact in time to help meaningfully reduce emissions. D, no, this is all just greenwashing. Tariq, while our audience comes up with their answers to that, Anne makes the point that it's not either or. Can we agree that perhaps a carbon tax is the first best option, ESG investing maybe the second best?
So that argument would have made sense to me a year or two ago. The reason I went public and made the argument that I have is, as I mentioned in the third part of the paper, that evidence is emerging. And I worked with the university in Canada to actually do a new study on this, that ESG investing and the messages around it are destroying the political foundation to create government reform. So there is becoming an either or, right? We can't say that ESG investing is a plus on top and it's not taking away from government action when there's clear evidence that the more you talk to the average person in the public about it, the more there's a statistically significant difference where they say we don't need government action. To put it this way, it's if you have a competitive playing field, the athletes are arguing we don't need rules and referees to change how the game is played. And if they spend billions of dollars marketing that and saying that good sportsmanship is the answer and we can build all the solutions we need that seem to be without government action, even though, again, the experts in our society and Nobel Prize winning economists are telling us we do, those messages actually mislead the public. And so that's the reason I went public, because it went from saying ESG is, a good effort to do things that could be useful to taking, zooming out and looking at the arc of history and realizing that this could be all the product of a set of win-win fantasies that unfortunately, there's no question that some of the tools and some of what's being done is moving in the right direction. So I agree with Anne on all of that. Where I get worried is the fact that, is it moving fast enough, right? We all know progress is being made. We could spend hours talking about initiatives, capital, small wins here and there. But then if you zoom out and you look at the overall report card, it's clearly not doing what we need done fast enough. It's clear that the experts are telling us that we need a set of reforms that will move those forward. For example, internalizing the externality through a carbon tax. And I get worried that the messaging that we don't need to internalize the externality, or that there's a win-win solution where managers, we don't internalize the externality, but managers consider it more. So now there's a process where the externality exists, but people are focused on it more when they make decisions. Having been a portfolio manager and having worked on one extreme end of distressed investing, a part of the market that fills the void left when people divest and they run away from out of favor assets, I can tell you that we would be all over that. We would invest in anything that was legal and made money. And the truth is, CalPERS is one of our investors, right? If there was a greater market opportunity in distressed, we would have gone and raised more money to attack it. That's not disparaging the system as much as I think it is being realistic about the way that it works. And the results we've seen over the last few years are that as ESG messaging has grown, as ESG initiatives have grown, as the assets under management have grown, they've grown alongside carbon emissions and inequality. And today, more than 50% of millennials don't believe in capitalism. I think there's one point I'd finish with. There's an important point I have to make around privilege. It's the idea that, we're all in this together fighting climate change. I'm not sure that that's necessarily the case, because when Noel Quinn says that he's optimistic about everything going on, I think if Noel's book was the same as Greta Thunberg's and he was 18, I'm not sure that he would be that optimistic. And that's just saying that, listen, timeline matters. And right now, if we're not moving fast enough, we're creating the sort of the preconditions for, a fantasy that says capitalism can fix itself. And the idea that it's not coming at the expense of government action when the evidence is showing that it does. And we may be just prolonging a system that is, oriented toward the short term and endangering the long-term public interest.
Well, perhaps another answer to this question, Tariq, is to fix the flaws in the ESG setup faster, put more pressure on funds to truly go green. How do you reallocate capital in a way that encourages companies to contribute to the climate transition?
Well, I think there's an interesting point in there. I wouldn't throw out ESG. The idea is not to just say that it's all nonsense. A lot of people say don't throw out the baby with the bathwater. I would agree with that. I think that there are, as I've said, tools, standards, and human capital that are useful. There are narratives and products that are potentially dangerous. And I think that there is an ESG 2.0 that is more rigorous about what can be achieved and what can't be, right? So that means that we can't go around marketing ETFs as providing more capital sustainable alternatives when they're not really. And I think that there is a second point around sort of being open and honest around the fact that there are limits, right? Responsible business doesn't mean, I think, business leaders going out and talking about stakeholder capitalism and serving all stakeholders when, all the recent studies show that sort of seems to be more PR. I think it's about understanding the limitations of what can be achieved in a system that is built through the sort of mechanics of fiduciary duty where a market failure still persists, right? And that's where ESG is a little bit dangerous today, I think, because it creates the idea that this can solve our problems. And again, what I saw at the largest asset manager in history across the data was that being responsible is not necessarily profitable or that useful to investing. And if it's not creating any impact and it's potentially delaying reforms we need, then we have to have that debate.
Okay, let's go to the results of our poll. 22% think that ESG is becoming an unstoppable force. More, 39%, if I'm reading that correctly, think that it will once we have better standards in place. And very few people think that it is, in fact, greenwashing. And to this point, reporting standards have been all over the map. Tariq points out, actually, in his trilogy in Medium, depending on how you measure it, Exxon may actually be greener than Tesla. Isn't part of the answer to greenwashing greater transparency, putting pressure on companies to report climate risk in a consistent way so that investors can make informed decisions?
Yeah, absolutely. I mean, I would liken this to going into a shop to buy a tin of beans, or a can of beans, I should say, for our American audience. You go into a shop, the tin just says, beans in here, price to be agreed with the cashier on the way out. We don't accept that as a form of reporting for nutrition, for even simple things. So it's no different when a consumer is buying a financial product. And there are existing, concepts of giving best advice, of fiduciary duty, which is overarching, in which the snake oil side of the selling game needs to be addressed. Now, the SEC is acutely aware of this. I mean, they issued a risk alert earlier in the year, shot across the bows to say we are inspecting and we will be enforcing, because if it's false advertising, whether it's on so-called ESG or it's on anything else, that's actually against the rules. So, getting those enforcement mechanisms is in place. That then poses the question, which you're rightly focusing on, which is, well, what should we put on the label on our can of beans, our tin of beans? How do we give the concept of true and fair, which we insist upon, to guide financial reporting under US GAAP, under IFRS internationally. So the important focus now is to get those standards written and developed. And I have high hopes for the new International Sustainability Standards Board. Think about that. This is going to be part of the delivery mechanism for corporate reporting into 140 markets, where we expect to have information on the finances, which is consistent, comparable, auditable, and interpreted and enforced through that regulatory mechanism. Now, if you look at what the SEC is doing, we and other investors were able to argue before the pandemic that this same approach, we're talking about climate change today, I know, but the same applies to human capital management. If you look at the S&P 500 balance sheet, you'll see it's 85% intangibles. So even if you just are interested to know where does risk come from, what's driving returns in a company, the current framework for corporate reporting is just too limited. So we do need the externalities pricing. That's not just carbon pricing. I would add to this hundreds of billions of dollars of fossil fuel industry subsidies. We need to pull the rug out on that. That's public money, taxpayer money, which could be deployed into better things, but as well as the carbon pricing. The other thing is that we need to focus on this reporting regime. Finally, we've got to find ways to extend that approach into private markets. And this has been something, I know this conversation has been largely about the public markets, but what's happening in private markets is becoming increasingly important. So the same applies here in terms of the standards and the reporting: financial, human, and natural capital. If you get all those three properly accounted for, and I use the word accounted for advisedly, you're going to actually find the financial markets in a better position. However, the SEC and other regulators have to continue with their, standard enforcement to make sure that, it does what it says on the tin. In other words, these products actually match up. They're getting away with it at the moment because there is no standard definition of what should be in the tin. So that's the piece of work that needs doing next.
Tariq, Anne has mentioned this idea of snake oil several times now. You were in the business of selling what Anne describes as parts of the industry, at least, snake oil. At one point in your critique, you talk about ESG funds being a way for asset managers to differentiate, and in differentiating, it allows them to charge higher fees. Is that what this is all about?
I think the majority of the products by dollar value out there that have the title sustainable on it are effectively not increasing any capital at all to environmental causes in any way that we could measure, or creating any impact against any specific metrics. I mean, think of an ESG ETF. The average person who buys that, imagine a retail investor or a millennial who decides that this seems like a good way to invest their 401k. almost certainly believes, and we saw this based on the study we did, that they're creating social impact that would not have otherwise occurred, right? This idea of additionality. In fact, all that's happening is a bunch of secondary shares, or trillions of which are already traded in public markets, are having the basket slightly adjusted so that you can charge socially conscious investors a few more basis points for the privilege of having value alignment. If you actually look at the theory of change for how that creates impact, and I did, and that's why I realized this is a problem. It's the exact same theory of change of divestment, right? Soft, ETFs. It's just soft divestment. Green bonds, the same thing. You could make an argument they're just moving money around from one side to the other. And if it doesn't create any impact, then $400 billion of these products may just be reshuffling things that already exist, giving us the impression that $400 billion have gone towards green energy and moving the needle, when in fact they're just reshuffling existing things, and getting a bit of a fee bump.
Tariq, I was just reading a report from one of the top business schools in Europe, EDHEC, called Doing Good or Feeling Good. And it was saying that academic research shows that only about 12% of so-called green funds are actually green, that in fact the weighting is enormously towards market capitalization. Was that true of the funds that you were engaged in?
I mean, I can't speak specifically to BlackRock's ones. I look across the industry. Generally, I did see that, the game in the industry, I think, is to take an existing product, make the minimal amount of changes you can to whatever it is, because it's already been optimized in some way, while getting the maximum marketing benefit from a green perspective. And so in a situation like that, where the incentives are set up like that, I think you're going to find a lot of products that are sort of mislabeled. And I would be worried about the fact that, number one, even if you label them better, right, and the SEC is successful, they're still wheatgrass. There's no evidence that any of them have any real world impact, number one. And number two, I worry about the idea that transparency alone is actually the solution. I mean, there's been transparency around CEO pay for decades. Guess what? It went up. There's been transparency in New York around calorie counts. It hasn't brought obesity. If the market failure persists, the fact that there's a transparency around it doesn't change the fact that the participants in that system are incentivized to fund and burn more fossil fuel than we need to occur as a society today, because of the persistence of a market failure we still haven't corrected. Again, you could say that the market failure is too hard to correct and so on and so forth, but right. The evidence is emerging that we can't correct it so long as businesses out there making the argument that this set of other solutions are a nearly as good version to it, versus what I would call, frankly, a distraction that is burning valuable time.
We're running out of time. Sorry, Anne, we're running out of time. I wanted to ask you, if I may, I wanted to get to the final question around divestment, because a lot of our audience are very interested in this question. We've just heard from Noel Quinn at HSBC, and that HSBC is getting out of coal, a decision that the bank made as a result of pressure from activist shareholders. That's surely a form of divestment, isn't it? Can't a similar argument be made for oil and other carbon-intensive industries? How do you look at this whole issue of divestment?
Yeah, no, thank you for the question. The point about divestment is it depends what you're trying to achieve. If you think divestment is going to change the company, good luck, because all that happens with divestment is one investor sells their shares to another investor who may or may not care, who may or may not be in public markets with reporting requirements as they come forwards. So if your reason for divesting is you see that those risks are ahead and they can't be mitigated through engagement, in other words, how do you transition a coal company into a renewables company? Then there's going to be a point where you have to walk away because you just don't see that as credible. And for CalPERS, we've got several sectors where we've come to that view. Tobacco is a good example. We don't see a way to engage tobaccos and companies, turn them into broccoli companies. And furthermore, there is no wider economic dependence other than for the poor, benighted, addicted customers of nicotine. There is no further economic purpose being served. Whereas if you look at fossil fuels, the reason that we have this engagement strategy for change is because the world right now is heavily dependent on these fossil fuels. if you sell your shares just in the producers of the oil and gas, you might feel, I've done a marvelous thing for the planet. However, those oil and gas emissions, 80% of them are going to be put into the atmosphere as those products are used across the rest of your portfolio. So the cement companies, the steel companies, transport, agriculture, dependence on fossil fuels means you can't simply be able to mitigate the risk simply by focusing on the production. We've got to bend the curve. The demand has got to come down. So that
Tariq,
is
do you
why.
agree with that? Do you agree with
Yeah.
that, Tariq? Get out of the oil companies or stay in and fight?
I think we're missing an obvious third option. If you get out, it's a complete waste of time. I think divestment has no value whatsoever. And I would tell you that it's like investors I talk to in the Middle East, they divest of, alcohol companies. Not one of them thinks that's going to stop people from drinking in France, right? We've divested of porn companies. This doesn't change anything beyond, I would argue, sort of an ability to cover yourselves. So I agree divestment doesn't help. I worry that engagement is also a distraction because, again, if you have a fiduciary duty to maximize shareholder returns and you're on the board of an oil company, like I can get a first-year banking analyst to do the model on that. They're going to tell you that the way you protect your profits and you maximize shareholder return, market, lobby, keep a carbon tax away as long as you can, and to keep exploiting that resource as much as you can. People in oil companies tell me
At
that,
which
right?
point, Tariq,
the answer is that we cannot rely on voluntary compliance. We cannot rely on voluntary compliance when there's a market failure. It just doesn't make sense. Fiduciary duty, voluntary compliance, it doesn't make sense. You can do something on the margins, but if I was on the board of a gun company tomorrow, what am I going to tell them? To stop selling guns? I mean, again, a first-year banking analyst can tell you that the best way to keep our profits existing would be to keep gun control at bay, right? If you want less shootings, you probably want the government to restrict it. At some point, we have to accept that there's a third answer, and it exists outside of the neoliberal universe of looking at how markets work, and it's that there are rules and referees, and they need to be updated. It's obviously the answer. Our societal experts are telling us that. I mean, if with COVID-19, imagine we said that the answer was not the government should close the schools and bars and restaurants and everything to bend down the curve rapidly. The answer is we should go one by one and join school boards and convince them to close. I mean, at some point, that's not a systemic solution, right? It may be better than nothing.
And let's get the last word to Anne, please.
Yeah, Tariq, you're setting up your straw object to knock it down. Investors are calling on governments to do their part. They're calling on civil society. That's a partnership that matters as well. And then, as the owners, we have responsibilities too. All of the above. Everyone has.
What exactly? What are governments to do? I'm not sure about that. I mean, have I seen a consensus out of investors and the financial community?
No, read the investor agenda. I don't think you know it, but it's
there's evidence that what investors are putting out there is destroying. There's evidence emerging that what investors are saying around ESG is destroying the political foundation for government action. How do you address that?
The reverse. It's highlighting the growing demand for these issues to be part of the public policy agenda. And that's true from the civil society activists through to the investors, through to the companies. We're the owners of this problem. We provide the capital and we own these companies, and we need to be part of the solution.
Thank you, Tariq. Thank you. And it's been an absolutely fascinating
game.
It's been a fascinating conversation, and we clearly haven't finished it. We're going to have you back again for round two. Thank you for your time. Thank you for your insights. And we have a final we're going to go to a final segment where we talk to Vice President of New Energy Business and Development, Jae-Hyuk Oh, at Hyundai Motor Company. I talked to him last week about Hyundai's commitment to reaching net zero by 2045 and how hydrogen technology is a key factor in the company's roadmap. Take a listen. Dr. Oh, Hyundai has just announced its commitment to get to net zero by 2045. And one of the strategies is based on hydrogen, replacing fossil fuels, not just for cars and trams and other mobility solutions, but also as one of the primary energy sources. And Hyundai is going to invest $6.8 billion in this project. Why this huge bet on hydrogen?
Yeah, there can be many different type of answers, but I want to say this. I guess it is not only because we chose hydrogen as a stairway to net zero, but also because we believe hydrogen is going to play a very important role in the realization of Paris Climate Agreement. I guess I have to elucidate what I just said. So let's first, hydrogen makes it possible to economically store renewable energy in a large scale. In fact, hydrogen's cost for storing 100 megawatt hour energy is calculated to be just 1/3 of battery's cost. So the more energy to be stored, the more competitive hydrogen becomes compared with batteries. So there's a clear cost effectiveness on hydrogen. Next, maybe you are wondering why it's so important to economically store renewable energy in large scale. That's because the amount of renewable energy available significantly varies time to time and region by region, and hence huge surplus of renewable energy is inevitable. So, for example, it is forecasted that there will be a huge renewable energy surplus up to 170 terawatt hour every year from 2050 only in Germany. So huge, surplus, we should, use it instead of throwing it away. So being able to economically store renewable energy in large scale instead of throwing it away plays a critical role in making investments in renewable energy profitable, and hence making such investments happen in practice. IEA forecasted that in order to achieve the goal of Paris Climate Agreement, the portion of renewable energy in the global energy mix should be up to 67% by 2050. I believe it is not impossible, to achieve that 67% in practice, since investment in hydrogen is profitable and hence is going to happen. So as a result, we can conclude that hydrogen is one of the must-haves for achieving the goal of Paris Climate Agreement. And I guess this may be a more important reason, for why Hyundai is so ambitious and aggressive about hydrogen. By the way, I want to add up this, based on the said importance of hydrogen, it's expected that by 2050, hydrogen reduced 6 gigaton of carbon dioxide annually and creates about the $2.5 trillion market together with 30 million new jobs. So why not hydrogen, and why not invest in hydrogen that much?
Well, the science is fascinating, but what are you doing to improve the cost effectiveness of hydrogen?
Yeah, actually, Hyundai is doing its best, to innovate the production, storing, transportation, refueling, and utilization of hydrogen in order to strengthen the cost effectiveness of hydrogen. For example, the electrolyzers we are developing will offer 10% higher efficiency and 40% lower capex, both of which I believe will lead to significant cost reduction in hydrogen production. Also, our ammonia crackers, which crack ammonia to produce hydrogen with the most competitive efficiency and capex, will enable storing, trading of hydrogen in the form of ammonia, which will lead to a significant cost reduction in hydrogen storing and transportation. So, in addition to those two, I want to mention about this too. Our state-of-the-art hydrogen fuel cell electric vehicles and hydrogen fuel cell based power generation systems are going to create steady demand for hydrogen, which actually encourages the investment on hydrogen supply side, and hence contributes to further improving the cost effectiveness of hydrogen. So, including the examples that I just shared with you, Hyundai is doing its best to innovate every aspect in hydrogen value chain so that the resultant cost effectiveness of hydrogen should be good enough to prove that storing and trading renewable energy in the form of hydrogen economically makes sense, and hence so much of renewable energy requested by Paris climate agreement also economically makes sense in practice.
What particularly caught my eye in the Hyundai announcement was this idea of 100% electrification of vehicles as a pathway to net zero. Can you tell us what kind of innovations Hyundai is undertaking to get to that goal?
I guess, every automaker is trying to innovate the electrification itself, but I have a little bit different view, by the way. So, by the way, Hyundai, plans to achieve, 100% electrification of new vehicles in Europe by 2035, and the other, major markets in the world, by 2040. Since, transportation sector is responsible for about 16% of the global carbon emissions, so, 100% electrification was to be critical to getting to net zero. But from the viewpoint of energy, 100% electrification has some implications that should be resolved, to achieve 100% electrification in practice. So one of those implications is the increase of electricity peak demand caused by EV charging. For example, assuming just 10 kilowatt, slow charging only, like as in residential facilities. Let's suppose that there are 100,000 electric vehicles. Then those electric vehicles will result in 1 gigawatt peak demand. This means that in order to accommodate that 100,000 electric vehicles, it is necessary to 1 gigawatt power plant and relevant electricity supply infrastructure, which for your information costed about $5 billion in 2016 in Korea. So $5 billion for just coping with peak demand is too much. So I believe we have to somehow reduce the peak demand, from EV charging. So one solution that Hyundai suggests is, hydrogen fuel cell electric vehicles, especially as a long-range, heavy-duty mobility solution, which can, significantly reduce the peak demand caused by just EV charging. Hydrogen fuel cell electric vehicles also need huge investment in building hydrogen supply infrastructure. But it is, I believe, worthwhile for you and me and everybody to invest in hydrogen, as I explained earlier. So the other solution that we are developing is the so-called demand management technology, by which we can more precisely predict electricity demand, less painfully control EV charging, and as a result, effectively reduce the peak demand caused by EVs under our demand management. So, what I can say is that Hyundai is pursuing 100% electrification, and in parallel, innovations to resolve its implications. We believe, however, solving implications cannot be done by Hyundai alone, but needs strong support from customers and governments.
Dr. Oh, the whole world will be looking with interest at Hyundai's pathway to net zero. Thank you for your insights into Hyundai's 100% electrification project, and thank you for your time today.
Thank you very much.
Our thanks to Dr. Oh and to Hyundai for taking the time out to do that interview on the exciting work they're doing. That's our show for today. We want to thank Tariq Fancy, Anne Simpson, and Noel Quinn for joining us earlier in the program. And to our audience, both within and beyond the Bloomberg New Economy community, thanks for joining us. You can follow the conversation with BBG New Economy on Twitter or like us on Facebook. Please look for updates on social media regarding the annual forum, which is coming up in November 17 to 19 in Singapore. Until then, stay well.